Well, I'm not going to lie. Sometimes I like to come into these interviews not prepared. I first heard about infinite banking and I was like, this is something I'm not going to Google because I want to understand this from your point of view, from your perspective. And then afterwards I'll dive into it. So the people want to know, what is infinite banking and how did you get involved in this?
Okay, so a couple big questions. Thanks again for having me here today. Infinite banking is a concept. First and foremost, it's a concept. It's not a product or service. It is a concept about cash flow, and it is a concept about how to leverage that cash for our benefit and maybe more benefit than we are used to having with certain amounts of cash. So that's sort of paramount.
Okay.
And then how I got to this was nothing less than divine intervention, frankly. I have a background as a public school teacher, and I've always had a business on the side. And I love cars, and all that ties together like this. I was teaching, and I had a side business doing car work and stuff like that. And I'd go to auto shows, and I listened to a podcast, and I met a new friend named Michael at a convention. And then fast forward, I ended up working with his wife for several years. And then Michael said, read this book. And I did. And it planted this seed in me.
What was the book?
The book was called Becoming Your Own Banker.
Okay. By who?
And the author is R. Nelson Nash.
Okay.
Becoming Your Own Banker by Nelson Nash. And I read that book, and a lot of things happened. This is probably 5 years ago.
Okay.
And a lot of things happened. First of which, I was a little stunned. And the second of which, it fostered a little... it fostered me to be a bit, A, inquisitorial, and B, frustrated. I might even use the word angry, but in mostly a polite sense. But I got a little upset, if I'm honest with you, because the concepts that I learned from this book are not concepts that are widely taught at all. They should be. They should be taught in every high school. They should be taught in every basic finance class. They should be taught everywhere, and they are not. And the fact that I didn't learn about this until I was 41 frustrated me. And that planted a seed inside of me you fast forward a couple of years, and now I had no idea that I'd be talking about this all day, every day to anybody who would like to listen. And that's why I say it's nothing less than divine intervention. If I wouldn't have this little, car hobby side hustle and met this guy, Michael, and then ended up working with his wife for years and years, I wouldn't be sitting here today. And he lives in Tennessee, right? It's just this very disjunct path about how I got there. And for me, it wasn't an accident. And I continue to be very grateful for what is this sort of grassroots effort, if you will. We'll probably get into that more and more as we go.
Perfect. So that's how you got into you had the book Becoming Your Own Personal Banker. You found out some concepts. So far, we've uncovered that infinite banking has to do with cash flow. When you say cash flow, I think of Robert Kiyosaki and Rich Dad, Poor Dad, which is a great book that I read. I'm sure you might be familiar with. And
absolutely.
So, I like that. So, but I still do not know what infinite banking is. I'm still confused, Pat.
That's okay.
Very confused.
Let's see if we can remedy some of that confusion.
Oh, thank God, goodness! I'm anxious, man. I'm excited.
Good. All right, so off we go. Infinite banking, as I mentioned, is a concept, not a product. And it's a concept about us taking control over the cash flow in our life, for one. And for two, being able to leverage a pot of money and treat it as our own bank rather than having to go to third-party lenders for as many things or for anything depending on a variety of situations, I suppose.
Time out.
So, yep.
Sorry. I'm sorry. Now my wheels are turning a billion miles an hour. Okay.
Good.
So this is what I think it is so far. I think that you save a bunch of money, right? You are your own bank. Then if you want to purchase something, you extract money from that pot, you buy the thing, and then you pay yourself back with interest.
You're getting close.
Okay.
Yes.
Okay.
You're on the right track.
I'm on the right track now. Okay. I mean, honestly, that's pretty smart. I think you can do things like that. I think you can borrow money. You could pull money out of, if you have like a Roth IRA, you can borrow money out of that and then pay yourself back interest. But I think this would take away from the taxes that you would pay by pulling that out of your retirement, because you get penalized. So I've kind of grasp a little bit of the concept, and I'm sorry to interrupt you, but that popped into my head. So I'm on the right track. So you've got your, so how do we get this giant pot to become the bank?
So what we do is we leverage a very specific type of whole life insurance contract.
Whoa, now I'm interested, sir. Okay.
So what we do is we leverage a whole life insurance contract with a mutual insurance company. Those pieces of information are critical. Not all insurance is created equal. Mm-hmm. Let's get that out of the way. Mm-hmm. Not all insurance is created equal. Most people don't understand it. Most people who sell insurance don't understand the majority of what they're selling, unfortunately. Mm-hmm. At least when it comes to life insurance. On the life insurance side, a lot of people don't understand all the ins and outs of what they're selling, which is sad. And a lot of people kind of get burned by that. Mm-hmm. And so when I say a specific type of whole life, it needs to be whole life, permanent life insurance, and it needs to be from a mutual insurance company. And if you don't know, a mutual insurance company means that policy holders, anybody who has a life insurance contract with that company, are part owners of the company, versus a stock company that has a big board of directors that profit from the companies. Yeah. Does that make sense?
It does. Yes, I'm with you.
So what happens is we design a contract on this whole life insurance chassis. Okay, we take a basic whole life insurance chassis, and not every insurer will allow us to do this. So we only work with a couple that give us, as infinite bankers, the freedom to build something that actually works as what we would like to call a banking policy, not just straight life insurance policy. We're building banking policies. And what that means is that you have a premium, which means a premium that goes into a policy. Yeah. Mm-hmm. Okay. We will take the biggest chunk of that premium. And in most policies, the big chunk buys death benefit and a small chunk goes to cash value. And the cash value is what builds up over time so that you could use it or take a loan against it to go buy yourself a thing or put a down payment on a house or whatever. Mm-hmm. In a banking policy, these are cash value heavy. They are lower death benefit, at least at first. Okay, so we take the majority of premium and we drive that to cash value. And then we have a smaller amount of premium purchasing death benefit. So a couple things happen. All right, First of which, a banking policy for the amount of premium that goes in will look like it has lower death benefit, and it will have lower death benefit for the amount of money that's going in compared to other types of whole life insurance. But that's okay, because we are driving as much money as the insurance company will allow us to drive. We are driving it straight to cash value, which literally means we are driving it to a holding tank. We're driving it to a holding tank, and that is critical. And it is different than a savings account by far, because in an insurance, let's talk a little bit about, this is related. Let's talk a little bit about financials, if I may.
Well, please do. You, I'm very interested right now. The insurance thing came the fuck out of left field, and I'm like, what? Okay, continue. Sorry.
Here's why. So, an insurance company, they have a big pot of money. It's a pool of money, And they have to pay death benefits out of that or any other claims out of that at a moment's notice when anything happens. That's their job. Okay. When you put your dollars in the insurance company's pool of money, they hold on to the actual dollars. It is backed up dollar for dollar. Every dollar that goes in is backed up by a real dollar that exists in real life on a ledger. Okay. It's not manufactured out of thin air.
Like the Fed. Gotcha.
You see where I'm headed with this. Not like our traditional banking system with fiat money and the Federal Reserve, which has nothing to do with federal anything. It's a private bank.
Oh, yeah. Real little side note, it sounds like you may have dabbled in the... Oh, man, what's the name of that book? Give me a second. It's about J.P. Morgan Chase and the formation of the Federal Reserve. The creature from something. John pulled that up. I'm sorry.
It's the creature from Jekyll Island, isn't it?
Yeah, that's it. I believe. Okay, sorry.
I actually have not yet.
Oh, dude, you have to read that book.
Okay, I will.
Yeah, continue.
In fact, I'll make a note of it just now.
Yeah.
So anyway, what happens in your regular bank, your credit union or your bank or whatever, is that every time you put a dollar in, the bank is legally allowed to loan that dollar back out to someone else and then earn interest on it, for one. And for two, they're allowed to loan out $9 more. Okay? 9 more that didn't exist. So if you go to your bank with a check for $1,000, okay, you deposit $1,000 in your account. The bank can turn around and take your $1,000 and lend it to anyone else that they wish, another client. Fine. They also, once that processes, once your check goes through all of the computer system and gets backed up and cross-checked with everything, they can go and lend out $9,000 more that didn't exist before. That's money that's not backed up by anything. It just exists on a book. That's a problem.
Yes.
It's a problem for a lot of reasons. It causes a lot of inflation. So let's talk bigger numbers. We talked $1,000, but who cares? Let's talk home mortgages, right? Let's talk. You go deposit $100,000. The bank can now loan $1 million. You buy a home you put a mortgage on the book for $1 million. They can loan out 10. So that is not a sound money solution. That is not a sound money solution. And secondly, as long as we're on the topic of our local banks, let's talk about this. Most people don't know this, so I hope this helps some of your listeners understand how banking works. Most people assume, let's use the drive-through window because it's the best visual. Okay. Most people assume that you pull up your car to a drive-up thing, and you pull out the little tube. And you open the end, you put your stuff in the tube, you put it back, and the vacuum system sucks it up into the ceiling, and it goes across to the person at the desk, teller. And then they open it. Thank you, the teller. And they open it, and they put their hand in, and they take the check or the money out, yeah? Most people assume that when that happens, the bank is going to be the steward of their money until they need it back, either digitally or physically, right?
Yes.
Fair enough? That is no longer the case.
Really?
Yeah, that changed. So in the crash of 2008, right? In the 2008 crash, we had a banking crisis. Banks were going under left and right and sideways and upside down. It was bad. Many banks never came back. A lot of banks were bailed out. And after that, say I forgot the year, but 2011-ish, maybe 2012, somewhere in there. The government came up and they passed this thing called the Frank-Dodd, that's hyphenated, Frank-Dodd Act, Dodd with 3 Ds, D-O-D-D, Frank-Dodd Act. And what that said was banks will not be bailed out again. If we have another 2008 crash or another banking crisis of any kind, banks will not be bailed out by the federal government. That will not happen.
Good.
Okay. So if you think about that, and I'm with you on that, not personally, on a personal level, I'm dead with you.
Fail.
I'm not for the bailouts.
100%.
But let's think about what happens. The Frank-Dodd Act said they're not going to be bailed out. So instead of a bank being a steward of your money You own it. They are being a steward of it. That was pre-Frank Dodd. Now we live in a post-Frank Dodd era. In fact, we live in a post-Frank Dodd era by a decade, and nobody really even understands what that means. Here's one of the things that it means. It means that as soon as the teller takes the money from the little tube that got vacuumed up from your car and went through the ceiling over to the teller's counter, as soon as the money pumps out of that and hits the counter, that is a legal change of ownership. That is a legal change of ownership. Now, the bank owns the money, and you have the first right to access it if it can be available.
Wait, what? Hold on. Dude, that's... I'm having a conniption fit right now.
Yeah.
So, are you fucking serious? Okay. Yeah. Now tell me if I'm freaking out right now. Now tell me if I'm right. Does that basically negate the FDIC, right? Because like, does that negate that essentially? Like if shit hits the fan and we all want to withdraw our money, does that technically mean because of this act that like you can't, we don't have it available. It changed ownership. You're fucked. Is that what that means? Is that what you're fucking telling me right now? No way, dude. No way.
I hate to be the bearer of that news.
Holy shit. I'm sorry. I didn't know that.
Nobody knows that. It was all done very quietly. It's all done very quiet. It's very hush-hush. And so now you're beginning to understand a fraction. I mean, we haven't even scratched the surface. You're beginning to understand a fraction of what started to piss me off when I read this book, Becoming Your Own Banker. I started to learn this stuff, and then I got angry because I'm like, where the heck was this 5 years ago? Why did I not know this? Why is everybody's money being owned by the bank with first right of access to a private citizen? Why is that the case? It's my money. I earned it. Well, lo and behold, the ownership changed so that a bank could try to remain solvent effectively if in an emergency, right? And not go out of business. It's a survival mechanism for the bank to not go out of business in an emergency.
Yeah, we're going to call pause. I have to talk right now. That is fucking crazy. I'm not surprised. I think it's hilarious just because like the banks, big pharma, they're all fucking evil, right? They also like it's a very complex relationship that our society has with them. Like they in the case of the instance of big pharma, they do a lot of really good things, right? They drive technology forward, and especially in the medical industry. And we just had a doctor on here. They're doing some crazy thing with nanotechnology and viruses. It's amazing, but they're also fucking terrible, and they're a bunch of money grubbing assholes. The big banks, right? You can't do shit. Like, I mean, if you think about the credit system that we have in the United States, is completely illegal, completely bullshit as well. You look at all these backdoor deals, and that's what, as soon as you said that, I'm like, that they probably have never liked the FDIC thing, right? They don't like that. A lot of these banks fail, and I've also been paying attention to a lot of smaller banks getting involved in like medical marijuana and charging absorbent fees, and then but they're smaller banks. They're forging these relationships. You look at some of the banks in Florida that were built off of cocaine money, right? A lot of those guys, they don't give a fuck, right? And it's interesting that I'm not surprised, right? There's a conspiracy theorist type person in me. And when you said that, it's funny to me. It shouldn't be, but I've read a lot of literature, as you could tell, on the financial sector because it's interesting. There's money, there's power, there's a little bit of politics, a lot of payoff, and some type of legislation like this would just get fucking swept under the rug. And then when the next thing happens, and we're all fucked, it'd be, well, this was passed. We're totally, and that's, you look at I mean, how many instances do we have to look at what Wells Fargo was doing in, I don't know, like 10 years ago? They were opening up accounts fraudulently, basically, to get fucking money. Like this is, the financial sector is rife with all sorts of bad things. So I'm not surprised. I am blown away, dude. I am blown away by all of this. This is wow. Sorry, man. I had to go off. This is crazy. This is crazy. Continue. Wow. All right.
So let's talk a little bit. And mind you, we're not talking about infinite banking, but what we are talking about a motivation for considering infinite banking as a place to leverage yourself and your life and your money, because this is what's going on in the background of an institution that everybody's already using, and most people don't know what the heck's going on.
100%. I mean, well, this is one way, right? We thought the crypto bros were going to decentralize everything, and now they're that's being fucked, right? I mean, listen, I love the idea of cryptocurrency. I own some for sure. I think it's fun to play around. I'm not a crypto bro by any means. But when the Fed is like, fuck all of this, and the banks are like, screw all of this, let's raise, like, that's going to shit now too. So this is another solution to hedge yourself against what's coming, because believe me, it's fucking coming. You know, we're in a recession right now. Yeah. And it's only going to get worse. Inflation's, I don't know, the last time we talked about it, it's probably at 11% now. John, pull that up. So sorry, dude. We're going to probably go a little bit longer. I'm sorry, Pat. This is good. This is good.
Fine. There's a lot.
This is good stuff. All right. So back on track.